What's up, everyone? I am excited to present this stock to you. I bought it last Thursday, September 24th. It is Equity Residential. They are a REIT. And I know what you're thinking, that real estates right now are kind of a bad or a tough investment, especially with the pandemic going around. But before you judge, let me walk you through my analysis, and hopefully we can both make some money. I'm anticipating maybe 40 to 45% return over the next 2.5 to 3 years. So I got in at $50.06. They are a $18.76 billion market cap company. Here's the stock chart. They're currently paying about 4.6% in dividends. So they own 304 properties. The average age of each apartment building is around 24 years old. They have about 78,400 units. 55% of the apartment buildings are in the urban core, and 45% of it is suburban. Most of their properties, if not all, are concentrated on top US metropolitan cities. That would be cities like Los Angeles, Boston, Seattle, San Francisco, New York. And I know they're really hard hit cities. I'm fully aware that I'm sailing into a storm. Normally, you would value a real estate portfolio asset by asset. There are two problems with that though. The first problem is EQR doesn't disclose to you property by property metrics, so you don't have that information. The second problem is that the apartment investment industry right now is a bit chaotic. So there are not enough buyers and sellers, rents are still going down, and so we don't really have a good gauge of market clearing prices. What we can do though is figure out, based on the stock price, what bad news has already been baked in, and then I'm going to handicap this company in 5 different ways by 5 different metrics. And what we'll do is compare our assumptions with the present market conditions. Now I gotta warn you, there's going to be a lot of numbers. I mean a lot of numbers. So go ahead and sit back, relax, grab yourself some popcorn, and maybe a beverage, some 3D glasses, and let's get this party started. So apartment valuations are all based from net operating income, or NOI. In the second quarter of 2020, NOI was approximately $441 million. And I'm using Q2 because that's when they were hit the hardest. So we're kind of starting from a very low base. So if you multiply the Q2 number by 4 to annualize it, you have $1.76 billion of NOI per year. And this is just the apartment income. So some of their apartments have retail on the very first floor. That annualized rent amount was about $37 million, and I'm going to completely ignore that. So in other words, I'm ignoring about $500 million worth of asset, just completely written off. Here's how their NOI is allocated across their cities. And here are their current occupancy metrics. And remember, these are end of June metrics. Okay, now let's further handicap the NOI. And I'm going to use an example, so these aren't the actual numbers. They'll vary by city. So imagine that $1.6 billion of NOI was exactly 100% of your total NOI. What we're going to do is we're going to slice off 5% for further vacancy. From what's left, we're going to slice off another 20% for rent decreases. So that 20% of the 95% gives you, the 19%. So what you have left is that you started with $1.76 billion, and now you have 76% of that. Okay, so let's apply this idea to our analysis. Here are the occupancy adjustments, and here are the rent adjustments. And the size of the adjustments are just based on what I've read about the markets so far. Now, the occupancy adjustment might seem kind of low, but take Boston, for example. Its current occupancy is at 94.7%, but that's already baked in the NOI. And we're going to further handicap it by multiplying it by 91%. So the effective occupancy is really 86% that we're modeling in. And I'm showing 91% there purely for the math, and I'll show that in a minute. So if you take this idea, here are all the effective occupancy levels. Okay, so just keep that in the back of your mind because I'm about to take it away. And this leads us to the total NOI haircut by city. So take New York, for example. You get the 65% NOI haircut by multiplying 90.4% by 72%. And the 72% is because you're taking 100% of the rent, but you're reducing it by that 28% discount. And so using all the NOI haircut numbers, we then have our newly adjusted NOI numbers by city. And you can see at the bottom, in aggregate, they're about 72% of where we started from. To think of this another way, you're basically slashing the entire rent roll by 28%, which seems really unheard of, but that's what we're modeling in. So now we take our list of new NOIs, and we're going to divide them by their adjusted cap rates. If you're not familiar with cap rates, it's short for capitalization rates. And cap rate, think of it as a required rate of return. It is a rate that you have to offer someone in order to attract capital. If an apartment building was worth $50 million and it generated an NOI of, let's say, $2.5 million, then it would be what we call a 5 cap deal. If you flip this equation around, that means if you have the NOI and you have the cap rate, then you can get the value of the asset. And the cap rate is not just one number, right? It's a mix of all the market participants that are buying and selling in the market, and so it's usually a range. And cap rates can differ based on, the age of the property, the location, the current interest rate environment, asset type, whether it's office, retail, or in this case, multifamily. I would say in general, the riskier the investment is, the higher the cap rate is required. So putting all of this together, what we have is a $26.8 billion portfolio. And subtracting the mortgage out of $8.4 billion, we have a net value of $18.4 billion. And the stock was trading at a $18.6 billion market cap, so we're about 1% difference from each other. So the stock is currently baking in tons of bad news. And now what we have to do is figure out whether our assumptions are in line with present conditions. Okay, I'm going to display a lot of data. Feel free to just pause whenever you need to sort of digest the information. EQR disclosed their average rents by city. And this is a mix of 1 bedroom, 2 bedrooms, urban and suburban, so just keep that in mind. And let's layer in our rent assumptions. So what used to be $3,300 in San Francisco, we're only baking in $2,400 now. And just kind of looking at this chart, I'm familiar with many of these markets, and these new rents are definitely a bargain. Here are the year-over-year changes in rents so far compared to our assumption. In the second quarter, EQR was seeing these set of numbers for their new leases. So some of this data, a little portion of it is already baked in to the current NOI. Here are the Zumper September rent reports for 1 and 2 bedrooms. And you can see that there's still, a bit of cushion that's left. Moving on to cap rates, here are the cap rate assumptions versus industry reports. And the CBRE reports are the year-end 2019 numbers. And right next to it, I'll show the Green Street Advisors third quarter 2020 cap rate report. So this is fairly recent data. And then just for context, I'm going to show you the 10-year US Treasury rate that was end of 2019 at 1.88%, and now it's currently 0.66%. And so the question is, have cap rates really gone up or down during the pandemic? And that's a really hard answer to deduce, because you would think cap rates have gone up because risk has increased. But then at the same time, interest rates have fallen 1%. And I know that cap rates generally follow interest rates. So there's not much data in the market for you to figure out where the market clearing price is. So the best guess that you can do is maybe bump up cap rates by a little bit according to the market reports. And, that's kind of the best guess that you can do. And here's the occupancy data. I'm trying to find more recent data, but the idea is that if you lower your rents to market, you should be able to maintain market occupancy. Okay, so let's do a recap. We started with a very low base NOI, and then we completely ignored the retail income. We've increased vacancies, we've decreased rents by a lot, and we've also bumped up all the cap rates. And all of that bad news is already priced into the stock. So in my opinion, you kind of have limited downside, and your upside could be pretty significant. But again, that's just my opinion, my analysis. I'm curious what you think, and let me know. Let me know down below in the comment section. If you enjoy the content, go ahead and hit like, subscribe if you want more of these kind of videos, and stay safe. I will see you next time. Thank you.